Welcome back to my channel. I've decided to make a series of videos where I teach you guys financial terms, words that you need to know in business. I never forget the first time I learned a few words that really changed my perspective on business. So today's word is bonds. Bonds. Bonds, commonly referred to as fixed income securities. Bonds are essentially investments in debt. I'll give you a quick definition as it reads here, and then I'll break it down on how you can use them, how you can invest in them, and potentially how you can use them for your startup business. So again, commonly referred to as fixed income securities, bonds are essentially investments in debt. When you buy a bond, you're lending money to an entity, typically the government or a corporation, for a specified period of time at a fixed interest rate, also called a coupon. This is, in the old days, they used to give you an actual piece of bond paper, and on the right, they would have coupons. So the bond would say $1,000 at 7% for 7 years, and then they would have these little coupons, and you would rip the coupon off and go to the bank and give the bank the coupon, and they would give you the 7% on the $1,000, right? Every year you would go and give them the coupon, they give you the money, and then at the end you return the whole bond and get your whole $1,000 back or $10,000 back, depending on how much the bond was. You receive the periodic interest payments over time and get back the loaned amount at the bond's maturity date. Bond prices tend to move in the opposite direction of interest rates. That is, when interest rates rise, bond prices typically fall. Okay, so why am I teaching you this word? Number one, for investing purposes. If you're going to invest, a lot of people love stocks because they go up and down. Some people like stocks because they give dividends. As you get older, you want a secure payment. That's where the bond comes in. So let's say you got a $100 bond that's 7%, that means you're going to get $7 a year until the bond matures. Let's say the bond matures in 5 years. So you're going to pay $100. You're going to get a piece of paper that's a bond, or sometimes it's in your Ameritrade account or Scottrade account or your Chase investment account, and it's going to show up as a credit or a debit. It's going to say $100 there, and every year they're going to send you a payment for $7 for 5 years. At the end of the 5 years, they're going to send you one last payment for $7 and your $100 back. That's essentially how a bond works. Now, if you're a startup or a corporation or a company seeking financing, bond financing is one of the best ways, or a way, to finance your company, depending on the venture. It's not always the best way. Sometimes it's good. Sometimes it could be horrible for you if you're not sure where your income is coming in. If you know where your income is coming in and you know the rate at which your income is coming in, you can issue bonds lower than that rate, and you don't have to release or relinquish any equity in your company. If you're not sure your return on investment, so if you're a startup and you don't know when the money's coming in, then you want to issue stock. That way you don't have to pay it back right away. That person owns an interest in your company, and you guys can maybe split revenue later on. But a bond, for example, so I'll give you a deal where I needed bond to get bonded out of a deal. I had a real estate deal. I needed some money for the closing. I knew I was going to get it back from another client. So I had another source of income somewhere else where I was going to get to $10,000 back. But basically I offered this guy 7% a year for 3 years on a $10,000 bond. So he gave me $10,000. Now I owe him $700 every single year for 3 years until the bond matures in 3 years. In 3 years, I need to pay him back the whole $10,000. Now I have an option in that bond to pay him back the whole $10,000 early with interest. So I can pay the $700 for the first year, and then I give him back the $10,000, and we are done. In that case, I got the $10,000. I used it when I got extra income in. I paid him off. I paid the $10,700. So that's one way to bond yourself out of a deal. Bonds are really great for real estate acquisition. So, for example, if you have a 100-unit complex out there and they want $10 million, and that real estate complex makes 9% a year, okay? So you can issue a bond at 10% a year, get the $10 million. Now your payment is on the bond 7%, right? So you're making 9% off of the real estate deal. You pay 7% to the bond owner, and you have the 2% left as profit every year. You can rework or refinance out of that bond, but that's a general principle. Again, this series of videos is just to kind of introduce you guys to certain words that you should know if you're in a business or you're investing. I hope this was helpful. Share it with somebody if it was. Comment underneath if you had any experiences with bonds or any other types of investments. Subscribe to the page if you like it, and we'll talk again next time.